Did you know that nearly 70% of investors lose money during market crashes, often because they aren't prepared? The next financial downturn could hit at any moment. And if you're not ready, you risk losing everything you've worked so hard for. But here's the good news. With the right strategies, you can safeguard your wealth and even come out ahead. This video will show you exactly what to do with your money before the next crash, so you can protect your future and seize opportunities others miss. If you're serious about securing your financial peace of mind, make sure to like and subscribe for more tips. Now, let me show you why this is so urgent and what you need to know before getting started. In this video, we'll explore exactly what you should do with your money before the next market crash. Whether you're just starting to invest or have some experience, understanding how to protect and grow your wealth during uncertain times is crucial. With the current economic climate in the U.S., characterized by rising inflation, fluctuating markets, and geopolitical tensions, the risk of a financial downturn feels more imminent than ever. That's why being prepared isn't just smart. It's essential for safeguarding your financial future. If you're a beginner or someone looking to refine your strategy, this video will give you clear, actionable steps to take now. You'll learn how to identify safe investment options, diversify your portfolio intelligently, and avoid common pitfalls that can lead to significant losses during a downturn. By the end, you'll have a practical plan to better position yourself so you're not caught off guard when a market turns. Remember, the key isn't just avoiding losses. It's about seizing opportunities when others are scared. So stay tuned. But to make smart decisions, you first need to understand the economic landscape we're dealing with. As we look at the current economic landscape in the United States, several key factors suggest we should prepare for increased market volatility. According to the Federal Reserve, inflation has been persistently high, with recent data showing a 4.5% increase year over year, well above the Fed's 2% target. This sustained inflation erodes purchasing power and prompts the Fed to consider raising interest rates further. In fact, the Federal Reserve has already increased rates multiple times this year, aiming to tame inflation but also risking slowing economic growth. Higher interest rates directly impact borrowing costs, which can slow consumer spending and business investment. Meanwhile, the latest data from the Bureau of Labor Statistics reveals sluggish wage growth, around 3% annually, struggling to keep pace with inflation, putting pressure on household budgets. This dynamic often leads to reduced consumer confidence and can trigger shifts in market cycles, with stocks and real estate potentially entering downturns. Housing markets are showing signs of cooling, with recent reports indicating a decline in home sales and mortgage applications. Rising mortgage rates, now averaging around 7%, make borrowing more expensive and reduce affordability, which can further depress home prices. On the market side, volatility is heightened as geopolitical tensions, such as ongoing conflicts and trade uncertainties, add to investor anxiety, causing swings in stock indices like the S&P 500. All these factors, the inflationary pressures, rising interest rates, housing market slowdown, and geopolitical risks, create a complex environment that demands cautious and strategic financial planning. With that context in mind, let's break down the strategy you can actually apply. When it comes to managing your money before the next market downturn, the key is to focus on protecting what you have while preparing to seize new opportunities. The main strategy involves building a balanced financial plan that minimizes risk and keeps your options open. This means diversifying your investments across different types of assets, such as stocks, bonds, and cash. Diversification helps reduce the impact of a market crash because not all investments will fall at the same time. Another important step is to maintain a healthy cash reserve, money set aside that you can access quickly without losing value. This gives you the flexibility to buy assets when prices are low or to cover unexpected expenses without needing to sell investments at a loss. You should also pay attention to the concept of risk management. This includes understanding your own risk tolerance, how much fluctuation in your investments you're comfortable with, and adjusting your portfolio accordingly. Additionally, consider reducing high-risk investments and increasing holdings in more stable assets, which tend to hold their value better during turbulent times. Finally, Stay informed about market conditions and economic signals. Recognizing early warning signs can help you make smarter moves, whether it's shifting your investments or holding on to cash until the storm passes. In essence, the goal is to create a flexible, well-rounded financial plan that safeguards your money and prepares you to take advantage of opportunities when a market bottoms out. Now let's look at a real-world example to see exactly how this plays out in practice. Imagine you're considering buying a home in the current market. Using a mortgage calculator, you find a property listed at $350,000 in a desirable neighborhood. With a 20% down payment of $70,000, your mortgage loan would be $280,000. At current interest rates around 6%, your monthly principal and interest payment would be approximately $1,680. Adding property taxes and insurance, your total monthly housing cost might reach around $2,200. Now, if you decide to rent instead, similar properties are going for about $1,800 a month. Owning your home could build equity over time, especially if property values appreciate at an average 3% annually, which means your $350,000 home could be worth about $360,500 after a year. Meanwhile, your mortgage payments are fixed, and part of that payment reduces your principal, increasing your equity. However, consider the risks. If the market dips or interest rates rise further, your property value might stagnate or decline, and you could face difficulties if you need to sell quickly. Plus, homeownership involves ongoing costs like maintenance and unexpected repairs. This looks great, but only if you avoid the common traps that ruin deals like this. When it comes to managing your money before the next market downturn, awareness is key. One common mistake is neglecting your credit health. Many people overlook their credit reports, only checking them when it's time to buy a home or get a loan. This can lead to surprises or missed opportunities. Maintaining a good credit score through timely payments and reducing debt can save you thousands and give you more flexibility when you need it most. Another error is overpaying on loans or missing out on lower interest rates. For example, someone might stick to a high-interest credit card instead of transferring balances or refinancing. Small savings on interest can add up over time, providing extra cash flow during uncertain times. Skipping due diligence is also a critical mistake. Investing in assets without thorough research can backfire, especially when markets are volatile. For instance, purchasing property or stocks without understanding the risks might seem lucrative initially, but can lead to significant losses if the market turns. Additionally, many underestimate the importance of an emergency fund. During uncertain times, having 3 to 6 months' worth of living expenses set aside can be a lifesaver, preventing the need to sell investments at a loss or go into debt. Finally, ignoring diversification can leave you vulnerable. Concentrating your savings in one asset class or sector increases risk. Spreading investments helps protect your wealth from sudden downturns. To avoid these mistakes, here are the best tools and resources available right now. In uncertain economic times, it's essential to take proactive steps to protect and grow your finances. Here are some practical tools you can use today to strengthen your financial position before the next market downturn. First, consider Credit Karma, available at creditkarma.com. It offers free credit score monitoring and personalized advice, helping you maintain a healthy credit profile, which is vital during economic volatility. Next, explore Investopedia at investopedia.com for comprehensive guides on investment strategies, risk management, and understanding market risks. It's a valuable resource for making informed decisions. For real estate insights, Redfin at redfin.com provides up-to-date housing market data, allowing you to evaluate property investments carefully. If you're interested in managing your investments, consider platforms like Robinhood, Robinhood.com, or Webull.com. These apps offer commission-free trading, making it easier to diversify your portfolio and transfer funds to safer assets when needed. Additionally, Personal Capital, personalcapital.com, combines free financial planning tools with investment tracking, helping you optimize your asset allocation. These platforms support a cautious and diversified approach, enabling you to review your credit, understand market risks, and adjust your investments accordingly. Now that you've got the tools, let's talk about the first thing you can do today to get started. Review your current credit report and identify any areas for improvement, setting a strong foundation for your financial stability in turbulent times. Imagine this. The next market crash could be around the corner, but the good news is you don't have to wait in fear. The first step you can take today is simple yet powerful. Check your credit report. It might seem small, but understanding your current financial standing is the foundation for making smarter decisions. By downloading an app like Credit Karma, you gain instant access to your credit score and report, revealing areas for improvement and helping you spot potential issues before they escalate. Taking this step unlocks clarity and control, giving you a clearer picture of your financial health. It's like turning on the lights in a room you've been navigating in the dark. Suddenly, you see all the obstacles and opportunities clearly. Once you see where you stand, you can start planning your next moves, whether it's paying down debt, saving more, or diversifying your investments. Each small action builds momentum and confidence, making the bigger goal of financial resilience feel more achievable. Remember, every long-term success story begins with a single step. Today, it's checking your credit. Tomorrow, it might be listing your expenses or simulating an investment. By staying consistent with these small actions, you're setting yourself up for stability and growth, no matter what the market throws your way. So, take that first step today, because momentum starts with action, and your future financial freedom begins now. Imagine yourself 10 or even 30 years from now, looking back at the financial journey you've taken. Consistency and patience are your most powerful allies. If you start today, even with small steps, those steady actions can grow into something remarkable. For example, by consistently saving and investing a little each month, you could own 5 cash-flowing properties by 2035, generating passive income that supports your lifestyle. Or picture your investments compounding over decades, turning modest contributions into a substantial nest egg. It's not about quick wins or taking unnecessary risks. It's about building a solid foundation that withstands market ups and downs. Over time, your disciplined approach can transform uncertainty into opportunity, allowing your wealth to grow steadily, even before the next market downturn. The key is to stay committed, review your finances regularly, keep investing, and let the power of compound growth work for you. And now that you see what's possible, here's how we wrap this up and take action. So, the key takeaway is building a strong, diversified financial foundation now will help you weather any upcoming market storm with confidence. Remember, reviewing your credit report, paying down debt, saving diligently, and investing consistently are your best tools to stay prepared for what's ahead. Thanks for sticking with me and tracking your progress toward financial resilience. You're making real moves. If you found this helpful, be sure to smash that like button, subscribe for more tips, and drop a comment below. What's your first financial goal for this year? I'd love to hear. And if you're ready to dive deeper, check out a related video on smart investing strategies during market volatility. Stay confident, stay focused, and keep building your financial future. Your best days are still ahead. See you next time.